Tuesday Carrier Update, sponsored by Powerfleet. My name's Kyle Cunningham. Thank you so much for everybody that's inside this building right now, whether you got here on Sunday, whether you got here on Monday, or whether you made it in this morning. We're so glad to see you and so glad to have you here. Today we're going to do a 20-minute Carrier Update. If you follow the weekly updates, you usually see it's around 2.5 minutes. So we're going to 10x this Carrier Update. And what we're going to do today, we're going to have a special guest. Trey Griggs can't stay away from the stage. Not just yet, but very, very soon. First, I'm going to run through the daily market updates, talk a little bit about what's happening right now. If you're inside the hall, you should be seeing Craig Fuller releasing Sonar 5.0. Wow, I've been waiting a while for it. But today what we're going to do is we're going to close out Sonar 4.0, and we're going to say goodbye, a sad, sad song, into a very happy song, Sonar 5.0 coming out. Let's go ahead and talk a little bit about what's going on today in the markets. So we're in Chicago, Illinois, and this is a feature I just wanted to touch on before we move away from it. A beautiful feature that came in that's close to my heart, the traffic overlaid in the maps really brought Sonar 4.0 up into the next level, really helping out a lot of carriers be able to move around and see these live traffic updates without having to leave one central platform. So as you can see right now, traffic's always backed up in Chicago. Rollover, wow, you can see right outside McCormick Place, everybody is struggling to get in here because it's the freight tech event of the century. Some said decade, I say century. Let's go ahead and move over into next slide, talking about Chicago, Illinois. And you know what? I did say slide. I guess the donuts are already here. So that's all right. Let's talk about Chicago, Illinois today. So outbound tender reject index, for my friends that are here today, if this is your first time at an event here at the FreightWaves Live in Chicago, Illinois, let's talk a little bit about the outbound tender reject index and what that is. If at any point in time you want to find yourself getting a little more information about Sonar, find out how you can use the outbound tender reject index to improve your business metrics, go down and see the guys at the FreightWaves Sonar booth. You cannot miss it. It's right across the street from JB Hunt 360. Speaking of donuts, I got to eat all these now, don't I? I got to eat every one of these donuts throughout the Carrier Update. Let's update you guys on what's going on in regards to capacity inside of Chicago. Outbound tender reject today in Chicago, Illinois, 5.57%. Not a huge decrease or increase. Taking a look at what's going on from pretty much the start of April to where we're at now, it's been very flat. We haven't seen it above 10%. We've barely seen it above 6%. So what that is telling, for those that are not familiar with the outbound tender reject index, about 94.5% of all contracted freight tenders are being readily accepted. So the tender comes over, and whether it's accepted by a human or whether it's accepted by a AI-based platform, quite a few amazing platforms which I've seen out there, whatever way those tenders are being accepted, that gives you the appearance of what's the capacity like in the market, what's carrier sentiment. So under 10%, it's going to favor the brokers, it's going to favor the shippers. So if you're on the brokerage side, if you're on the shipper side, you're going to have some cheaper capacity today. If you are holding assets in the great city of Chicago, those assets are going to be a lot cheaper today than they were yesterday because it's only gone up by 2%. When we see these big capacity crunches, if we look back at around August of last year, September of last year, you can see big moves where the outbound tender rejects are almost in the same line as the volume. So that the green line or the yellow line, I need someone to help me figure out what color that is, right? So whichever way the volume lines are trending, you can see the outbound rejects have dropped way, way lower than that point last year, indicating there's just a ton of capacity inside of the market. So taking it over to the next one, let's talk about the concept of volumes coming out of Chicago. This one was a surprising one to me. So the data in Sonar is the fastest freight data at the speed of light. You're never going to find freight data faster any platform on Earth. What we're looking at is the city outbound tender volume index, the tweener, and the long haul outbound volume. So if you're a local carrier in Chicago today, you're going to have 5.1% more freight headed outbound within a 100-mile region than you did yesterday. So once again, talking about this freight tenders and the concepts of being able to measure these things, the data inside of this platform has never been seen before. In fact, there's a guy right there you want to talk to, Kyle. Go see him down at the FreightWaves sonar booth, and he will give you all you need to know. Now, if you're not a city carrier, if you're not looking to stay local and you want to get out down the road a little bit, the tweener outbound volumes and the long haul outbound volumes remain nearly the same in terms of weight, in terms of the amount of freight moving out of the markets. But you can see that tweener runs between 500 and 800 miles, where it really kind of drags on the ELDs, not able to get that full 800 miles in for the day, but 500 is just a little too short. The tweener outbound, long haul outbound, short haul, about half of the city volume. So that tells you just how much freight is flowing within the city of Chicago. So let's take a look at the local tender rejections, and you can see it's quite volatile. The bottom line stands around 2.5%, and there are times when the city capacity reaches a crunch to where up to 6% of outbound city tenders are being rejected. So if you come into work and you see that the outbound rejects are elevated in whichever market or whichever type of freight or length of haul that you see, understand that either your freight is going to be a little cheaper today or your assets are going to be a lot more valuable. So understanding how to interpret these different charts and graphs, go ahead, head on down to the booth, talk to my friends down there. You might even see me down there after this. I'd love to speak to you as well. If you have a perspective on sonar, and this goes for anybody in the building, I would love to hear what you're talking about, how it's treated you, what technology has helped you in your business. Let's take it over one more time, and let's take a look at went a little too far there. Let's take a look at the DAT long haul van rate in comparison to, now that we've learned about the outbound tender rejects, let's talk about one more amazing feature that you'll only find in sonar, and that's the outbound tender lead time.usa. So we're measuring the outbound tender lead times, the times from the acceptance of the load to the actual pickup of that load, currently coming in at 2.65 days. So from acceptance of the tender to the pickup, 2.65 days. Seeing that orange line there, tender lead time, up about 14% from the origin point of the tender lead time. As the lead time is going to increase, you're going to see a weaker rate to the truck. As the lead time then decreases, you're going to see a stronger rate to the truck. The outbound tender reject down 78% from the origin point, indicating that there is a lot of capacity in the market. If you take a look at the top line there, that green line, that's the total fleet counts for hire in the USA. So there is, let's see here, 1,608,243 total fleet counts in the USA. That line trending up ever so slightly in same pattern as the DAT rates. So you can see that the capacity that entered into that market, the fleet count continued to climb, the capacity comes in, the rates then fall down. Let's take a look at our head haul map for the daily, talking about what's going on in regards to capacity inside of the market. See, in the blue zones, you're going to see a lot more outbound freight. When you find yourself a red zone, that's going to indicate that there is a way more inbound capacity versus outbound. So if you're a broker, if you're a shipper, you find yourself having freight within a red zone, that's when you're going to have a little more power or a lot more power depending on the depth of the color. For the carriers out there, the blue markets today you want to watch, Memphis, as always, taking a look at both Southern California markets. Beautiful, sunny Southern California, topping out about 14 degrees here in Chicago today. So I can't say I'd want to be anywhere else, though. I'm quite pleased to be on the stage. Let's take a look at the outbound tender rejects out west, Spokane, Washington here, 10.18, just above that little point where the carriers have the most amount of control. You can see this market's quite volatile in between this channel that I've drawn here. Let's go ahead and take a look at a deeper kind of sentiment inside of this wider channel. The outbound rejects tend to fall somewhere between 7 and 15%. So it's very important to take a note of what's happening in the market. If you have capacity in Spokane, as these begin to trend up, look for patterns and look for the same things that have happened in the past. If you see these things happen before, they're generally going to happen again. Being able to forecast, being able to get a jump ahead on the competition, that's going to enable you to make more revenue and keep those trucks rolling. Let's take a look even deeper, and you can see that within the last few weeks, pretty much from mid-September to today, the rejects have floated above 10% generally. So that's a pretty strong sign. Spokane being kind of out of the way, off I-5, away from 25. It's going to just remain essentially a shorter capacity market. But if you are running anywhere out west, Spokane is one you got to take a look at. Let's move over and take a look one more time. Outbound tender rejects for Boston, Massachusetts. Wanted to highlight this one just to show. We've got our Chief Insight Officer, Dean Croak. He's from up that way. He made it in. I saw Boston today. Big move up 32%. Boston's pretty much a low capacity market, or excuse me, high capacity market, low reject market all the time. So seeing these come up indicate that if contracted tenders are being rejected, then we've got ourselves in a situation where the truck is going to be more valuable today. Time's closing out. We got a big man, Trey Griggs, come on up here and say what's up. You know, this guy is just too popular. You can't stay away. What's up? All right. So, donuts. Did you see the donut guy presentation?
I did. I went in just to see the presentation. I saw the donuts. I thought I better be in there.
Right on.
And yeah, this is actually my third donut, so I'm pretty excited.
I'm disappointed in you. You've only eaten 3.
Well, I ate 2 in there, and that was pretty impressive because people, were around me.
You cannot leave the stage without eating all these donuts now. So I hope you know what you got yourself into. Tell the folks out there what you do, where you're from, what brought you here.
So I'm a technology consultant, sales manager for Trucker Tools out of the St. Louis market. Been in the industry for about 8 years and focused primarily on providing technology and creating efficiencies in the freight brokerage side.
Excellent. And so did you find yourself in the transportation space because of a draw to it, or was it something that just happened?
No, it totally happened. I don't think we have the time for the story today, but it followed after 15 months of door-to-door office supply sales to cut my teeth in sales after being a teacher for 8 years.
Wow.
And then my recruiter had a connection with a technology provider out in Portland.
Right on. So you've seen a little bit of Sonar, maybe a lot of Sonar. What was your perception of 4.0 previously? I guess, well, you haven't seen 5.0. It's going on right now. That's right. It's going on right now. So what we want to do is I want to catch up with you later on in the day, and we'll have a talk about the new features inside of 5.0. But let's just have a moment of silence for the disappearance of Sonar 4.0 as we move into Sonar 5.0. If you're inside that building right now, I know Craig Fuller is taking charge and showcasing what's going on. 5.0 is going to change the freight game. It's going to change the freight industry. It's going to change your business, and I dare say it's going to change your life. So that's Kyle Cunningham out for the Carrier Update, sponsored by Powerfleet. Thanks so much for everybody sticking around. Thanks so much for being here, making it down through the ice, through the snow. Thanks, Trey, for coming on. Enjoy that donut.
Mm-hmm. Thank you.
We will see you again tomorrow. Take care.
The comprehensive logistics offerings from Powerfleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with Powerfleet.
Sponsored by JB Hunt 360. We continue with our monthly market update here from FreightWaves Live. Anthony Smith joins me today. Anthony, how are you?
I'm great. I'm amazing. There's so much, it's great energy here. We are doing amazing things here. Happy to be here in Chicago.
Yeah, it's a good time. A lot of energy, a lot of energy. So there's our faces. You see us. You've met us. Anthony Smith, our lead economist, Zach Strickland, Sultan of Sonar, FreightWaves. So who we are, I think everybody here generally knows who we are at this point. FreightWaves, aggregating the most data in the industry of anybody thus far. We continue to do so. Lots of data behind the scenes, lots of data analytics, and really a big point here is that not only do we collect the data, but we provide the context for the data, which is so often missing.
That's right. We have an expansive team of market experts, you and myself.
Correct.
We also have market experts for final mile, shippers, brokers, air cargo, maritime. We have just about every single segment of the freight industry covered.
Everything. And if I didn't mention it before, this is FreightWaves Now, sponsored by JB Hunt 360. So Anthony, what do we got this month? We give this monthly market update every month. It's been a couple of weeks so far, but we're going to go ahead and give you another quick inter-monthly update.
Yes, that's right. So quick inter-monthly update. We're going to chat about, I think one of the things that didn't come out last time since we chatted was GDP results. We're going to look at manufacturing segment overall.
Manufacturing, one of my favorites.
Yes.
Not doing so great.
And consumer trends.
All right.
Maybe some consumer confidence. What about you?
Yeah, I'm not into consumer confidence. So I'm going to be looking at our volumes. Finally, the year-over-year comp starting to look negative again after having about 3 months of pretty solid numbers. The volumes were up, capacity still not tightening significantly. We did have a decent month of September in that regard, but it's starting to come back down. Capacity is actually somewhat loosening leading into peak season, which happens every fall in the towards Thanksgiving.
That's
so
right.
Let's get started.
So just kicking things off, I think one of the things that we all saw happen was the latest headline number for GDP, right? So we saw that GDP came in at 1.9%, I believe, Zach. And so a slight decline from the 2% in the previous quarter, but much better than the consensus results. I think most people were expecting 1.6 or something like that. So
I was going to say it was still well above expectations.
Still well above expectations.
But 1.9 historically isn't necessarily robust.
Not as stellar,
Right.
Not as stellar as what we've seen before in previous quarters. But big takeaway here is when we're looking at freight, when we're looking at the GDP, there can be a disconnect when we're looking at the headline freight number. So you can have GDP grew at 7%, something crazy like that, right?
That's too much.
That's too much growth. But it doesn't really translate over to freight movement or movement of stuff throughout the country. So one of the important things to do is strip out those services from the GDP. And so that's what we have when we look at the goods adjusted GDP, is when we look at what the goods segment of the economy is really doing, not just the services, because the service side is a huge component of it. Even larger is the consumer component. So when we're looking at consumer expenditures, it's going to be roughly 70%, just there about 70%. And so it's important to look at what's happening with this consumer, and more importantly for freight, what's happening with the actual goods, stripping out all the services. And when we do that, we see a slight tick up. So that's promising for the previous month that we've just seen.
But this is for August, right?
Yes.
Yes, August.
Yes.
It's a little bit of a lag.
A little bit of a lag comparatively, especially for our sonar.
But still, but still, the update is significant because it's an uptick. It's the first uptick in a few months. So we might have a slight bit of recovery.
Exactly.
All right. Well, what's we got next?
So next up, we have personal consumption expenditures. As we're talking about, the consumer is a huge part of moving freight throughout the country. And so when we're looking at consumer expenditures, we did see a nice tick up on a year-over-year basis. And so that's going to contribute to freight volumes. Again, this is only through, I think the latest numbers from the U.S. Census Bureau is through October. Right. So it's not going to quite capture what we're seeing in the most recent weeks here, where we're seeing that dip off in volumes, as we mentioned earlier. And so when we're looking at the consumer, the expenditures segment really provided the backdrop for the most recent GDP numbers.
Now consumer consumption, does that kind of drag the economy? Or is
it's been propping up the economy, especially as we look at the wavering trends in manufacturing and things like that. So when we're looking at the GDP, the consumer consumption expenditure has really been that stronghold for the U.S. economy, and also has a lot of implications. We're going to look at durable goods for movement of freight. Because
essentially everything that moves on a truck is going to eventually, that somebody's purchased that and they're trying to manufacture it. So why is there such a disconnect between personal consumption and the durable goods sector?
So personal consumption can include things that are services, professional services, things like that. Durable goods are goods that are actually made, actually produced. And so these are the things that get moved around the country. These are things that are like couches, furniture, appliances, toys, your Xboxes. I'm a big fan of the
Nintendo Switch.
Yes. So these are the goods, the electronics that move around the country, that are being transported via freight. And so that's much more important to look at when we're looking at the state of freight overall.
Really, the consumer has been just driving a lot of what we've seen in the economy this year, correct?
Exactly. And next up, we have the Purchasing Manager Index from the Institute for Supply Management. And so when we're looking at the PMI, the latest PMI, we saw that it ticked up to 48.3. So this is, I think, the third month that is still below that 50 threshold. But
which is contraction, right?
Contraction.
Anything below 50, not great.
Anything below 50,
Yeah.
not great.
Yeah.
And so when we're looking at that contraction, it's concerning. It's been a
Right.
long time coming, as
Continuing.
you see in this chart, and it has implications, especially for dry van and flatbed. So in the chart behind us, we have in the green line flatbed outbound tender rejections, and so when we're looking at that, we can see that it's really holding down.
And you chose flatbed because essentially, a lot of these goods are moved on a flatbed truck. Because
Exactly.
construction, things like that, manufacturing,
Machinery, yes.
things like that are
Yes.
hauled on flatbed trailers traditionally.
Exactly.
All
And
right.
so
It's an interesting correlation.
Yes, and as I mentioned, so this is still below 50, but it bumped up to 48.3. Some people are saying, Zach, that this might be the bottom and it's all up from here. I myself, I'm not buying that right now.
No. It's hard to call the bottom
It's
when
hard to
you're
call
in a
it.
free fall.
Exactly,
You know?
exactly. So I think the tick up is nice. It's promising, all that good stuff, but I don't think we're at the bottom just yet. Too early to call.
Really?
Too early to
So
call.
basically this is just a near-term correction, just saying regression towards the mean a little bit.
Yeah.
Get back up, and we're probably going
I
to
don't.
saying you don't think it's going to.
I don't.
We're not
think
going to
so.
continue.
No,
All
I don't
right.
think so. We'll see.
Ooh, that's rough. Rough. All right.
So next up, we're looking at something a little bit less durable, non-durable manufacturing. And so when we have non-durable manufacturing, we saw that the latest numbers declined by 0.2%.
Now explain what I guess you're going to. I'm getting ahead.
Yeah. I'm glad you asked. So non-durable, anything that has a shelf life of less than 3 years.
Okay.
And so this can include a variety of things, but one thing I like to focus on is the food and beverage components, because that's going to make up roughly 1/3 of non-durable manufacturing. And when we're looking at that component, that's going to have direct implications for our reefer outbound tender rejection index. When we're looking at refrigerated trailers that need to be to carry goods that need to be in temperature-controlled environments. And so when we're looking at that, we saw that increased slightly for the month, but it wasn't enough to really bring up the overall trend for non-durable goods manufacturing. Other things that are in there are like rubber products, chemicals. I know sometimes during depending on where things are in manufacturing, sometimes some of those rubber products or raw materials need to be in a temperature-controlled environment. And so this is, I think, one of the key metrics to look at when we're looking at diagnosing what's going on within the freight industry. But when we're looking at our OTRI, that gives us our reefers. It gives us a day-to-day outlook. And so while we're waiting for month-to-month movements in these government-provided data sets, which are amazing, helps diagnose, it's too late. It's too late. And so when we're looking at our sonar data, it tells us ahead of time what's happening, what's going on.
Because transportation does tend to lead the economy, as we found.
Yes.
Watch what's moving on the trucks. That's what's happening.
Yes, exactly.
Interesting.
Exactly.
So why are we seeing this kind of downward trend in the non-durable goods? Are we? Is it a cyclical thing? Is it a seasonal thing? What are we?
I think some of it is seasonal. So we did see a tick up in the food, beverages components.
Mm-hmm.
So we saw a tick up there.
Right.
So I know we're in the midst of. Which produce is it? Did we just finish potatoes?
Potatoes and apples.
We just finished potatoes and
potatoes
apples.
and apples out of Washington and Idaho.
Exactly.
Yeah.
So I know we just finished that, and so that's going to help lift our reefer outbound tender rejection index. But when we're looking at the non-durable goods, I think we're also going to look at chemical productions. We're also going to see other areas like that are going to be dragging on the overall segment instead of carrying like the food, beverage, and tobacco segments of it all.
Right on. Well, I seem to have lost my control for the slides.
Uh-oh.
Yeah. So we can just talk through some things.
We can just talk through some things.
Yeah, we can just talk through some things.
So
As we've lost control for the slides.
yeah, and
If
I
anybody's
think,
listening.
and continuing with manufacturing.
So manufacturing.
We also look at industrial production. One of the things I love about industrial production
Now, industrial production is really it's a huge indicator, not just for the economy, but for freight movements in general.
Exactly.
And that's because a lot of these durable goods are manufactured and they're shipped on trucks. A lot of the stuff that happens prior to, getting shipped on trucks like the orders.
Yes.
All of this stuff combines together, and industrial production really drives a lot of demand side growth and transportation.
It shows all of that good stuff. And the thing that I love about industrial production is it's a huge data set. It shows us different segments of the economy. So we have industrial production. It's mining, utilities, and manufacturing. Manufacturing being the huge portion of industrial production. But when we're looking at industrial production, we can break it out into different segments. And government loves to categorize things and be very precise. And so that's what I love about it. And so I think when we combined it with our indexes, like our van outbound tender rejection, and for example, those of you that are our Sonar subscribers can make this comparison and look at our VOTRI.USA compared to industrial production just for manufacturing. And so that's going to strip out some of the other aspects, like we were just looking at refrigerated and non-durable goods. We can also break out just manufacturing. We can break out just machinery. And actually, one of the things that we saw in the latest manufacturing segment of industrial production was that the machinery component was down 1.4% month to month, and also well below year-ago levels. And so that's going to be a really telling for when we're looking at the van outbound tender rejection. We're looking at flatbed, and so
because van and flatbed traditionally are going to be impacted by this type of production, this activity, this macroeconomic activity.
Exactly.
And we can see the clear correlation and connection there. It's funny to me how seasonal macroeconomics is.
Right.
Along, like trucking traditionally is a very seasonal activity. We see these. We have 2 peaks every year. We're about to hit the second one.
Hopefully.
Yeah, hopefully. And to see some of these macroeconomic indicators move seasonally with this activity, why do you think some of that is? Do you think there's?
Well, I think a lot when we're looking at the freight industry, we're looking at the distribution and the distribution of goods.
Yeah.
And I think that's a huge part of economics overall.
Sure.
And so we're looking at it, everyone always says supply and demand. Transportation, supply and demand. And so when we're looking at the logistics industry, we're looking at that at a microcosm, a smaller scale in different segments. And so I think when we see those two, we have to be careful at where we kind of make those comparisons.
Are in the seasonalities.
And make those seasonalities line up. A lot of times I like to diagnose what I'm seeing in the data as opposed to like go looking for it and then kind of hunt those trends out.
Inductive versus deductive.
Exactly. So got to be careful of that.
Because we all fall into those traps where we think we know something and we apply what I knew last year to this year, and that's just not every year's the same.
Exactly.
Every year is a snowflake, a unique.
It can
snowflake.
rhyme a little bit.
Yeah.
It's not going to be exactly the same. It might just rhyme a little bit.
Right.
A little different.
So let's talk about housing starts. So this has been a big struggling sector of the economy over the last, I guess, year really. But yeah. So
it has, and as an economist, you kind of get tired of making excuses for the housing segment. So all year we've seen that, especially when we're looking at sentiment indices. I know you're a big fan of the sentiment indices.
Not a fan of sentiment. I don't like emotion in my data.
I love them. But when we're looking at housing starts and we're looking at construction overall, we're seeing that there is a demand for homes, especially entry-level and mid-level homes.
Right.
There's been a supply-side issue, whether it's on new builds, being able to find skilled labor, or if it's been within existing homes and available homes in inventory that are available for purchase. And so that's really been driving up prices despite having mortgage levels being so low. Another issue plaguing new builds is available lots. And so there's been these small little things that's kind of been taking jabs at housing starts and new construction, things like that, while demand is still relatively high, especially when we're looking at things like the home purchase sentiment index.
I feel like buying a house today.
Yes.
I don't have any money for it, but I feel like buying it.
It tells a lot because it has different components, right? So it has components of like, do I think my income's going to significantly increase in the next 12 months?
Because I'm very accurate in predicting that.
Sometimes. And when you feel less certain, you're going to be less inclined to make purchases, and then that has implications other sides, segments of the economy, especially when we're looking at retail sales. And
I'm gonna start predicting this on my daily emotions. I'm gonna do it.
I'm for it.
Yeah.
I'm for it. I want to make
Anthony,
a ZAC index.
I don't feel like buying a house today.
Yeah.
So my housing index is going down.
I'm going to start tracking this. You think I'm joking? I'm tracking this. Actually, I've been tracking it without you knowing for a while.
Right. Makes sense. Internet of Things.
Yes. And so real quick here with retail sales, we saw the first monthly decline since February in the most recent month. It was a decline of 0.3%.
That's not good news.
Not good news. A shakeup in some consumer activity, because even though we have great employment trends, we have good wages, the confidence, the sentiment.
Here we go again.
The sentiment is not there. And so we have things like a full trade deal yet to be reached.
Right.
We haven't seen substantial increases passed on to the consumer, but I think once we start to see large price increases, that could be a huge shakeup if we don't have any type of resolution here. We're looking at just trade deals overall.
Wow. So the trade war is having an impact here. That's what you're saying? Or potentially?
Potentially, yes. That's what I'm saying.
People are uncomfortable.
Exactly. And lastly, but not least here, we have the Logistics Managers Index. This is put together by the good people over at Arizona State, Colorado State University, Rochester Institute of Technology, Rutgers University, University of Nevada, Reno, and in conjunction with the Council of Supply Chain Management. I hope I didn't forget anyone out there. I think I covered it all. So what this is similar to the PMI. And so anything below 50 indicative of contraction, anything above 50 indicative of growth. And what we saw is that the LMI is at a historical low, still over 50, but when we look at the different components, the prices component down to 43.5. So this is at historical low.
Wow.
And the capacity component is increased to 65.4. So that kind of tells us.
That's what you'd expect, though.
Right.
Capacity increases, prices decrease.
Exactly.
Supply exceeds demand.
Exactly.
There you go.
And so that really corroborates well with what we're seeing in our outbound tender rejection indices and things like that. Increased capacity is going to really hinder.
These really feel directionally accurate. You know what I'm saying?
Yes.
They feel like they're capturing the transitions really well.
They feel that way.
No, I think
feel
that's,
that way.
I think
you
that's
see
fact.
that?
You're trying to trick me again into my feelings.
Exactly.
I don't trust those things.
Economics is a social science.
Yeah. So let's dig on into that freight market.
Let's get it.
Yeah, so I like to update everybody on the volume situation. Volumes fell below 2018. I know everybody thinks 2018 was this big, robust freight market, and it simply was for the first half of the year. Now, the second half of the year was not that robust.
Right.
I mean, traditionally. We had a really soft October. It led to a marginal November and a very muted peak compared to the summer peak.
Right.
Basically, the market just kind of fell off a cliff there. You see the outbound tender volume index behind me. That green line is last year. You see that thing started to tick up in the first week of November last year, and now we're directly under that. And a lot of this softening has to do with the West Coast.
Yeah.
So the trade war has really had a noted impact on the freight market on the domestic side, and I'm using facts, not feelings. Just going to put that out there. Yeah, the trade war has really altered the landscape over the last several months to a year, and the West Coast volumes have really propped up what we've seen in the freight economy. LA, Ontario, if you look at a Google map, you will see just a spread of warehouses and DCs. This is really, to me, kind of the pulse of the freight economy, especially leading into November, December peak.
Right.
Because that's where a lot of these warehouses are positioned. A lot of freight market activity comes off the West Coast, goes into the East Coast. Now, the trade war has had all this pull forward. So volumes behind me here, you have the Los Angeles outbound tender volume index. And we saw a lot of those volumes really jump up early part of the year. And LA, anybody that's been involved in freight markets over the past 5 to 10 years knows that LA early half is not strong until produce season kicks off.
Right.
And then second half of the year, it really kicks off because after everybody has pulled all this freight into the country, they then ship it across to the East Coast. This month, that volume just collapsed.
Right.
Now, something to note that I haven't broken out for you is that the long haul volumes really did jump up. A lot of what you're seeing here in the fall off is the shorter haul, the regional movements that we've seen elevated activity in. So Los Angeles doesn't ship from the West Coast all the way to Maryland, throughout the year. That happens traditionally in September, October, November, right before retail peak. So these movements that you're seeing here fall off are actually a lot of those regional movements, warehouse repositioning, because of the abundance of freight coming into the country. We've watched some of that, all those, I think last month I gave a nice chart about the retail customs imports and how they've really fallen off year over year, as much as 20 to 30% year over year down, because they just brought everything into the country.
So what was the purpose of the pull forward?
The pull forward was trying to avoid tariffs. So a lot of these suppliers over there, as they're sourcing their freight a little differently, because they're starting to shift that to Southern Asia, but a lot of that activity is driven by this idea that they're going to escape some of those additional costs imposed by tariffs. Well, those costs get passed along just like anything else.
Right.
The suppliers, they have to pass those costs along. It comes back into the United States, but it really doesn't add up to the total. Like the net just isn't necessarily the same number, because we see those tariff revenues as as a country, but it doesn't necessarily add up economically speaking.
Sure.
I think it was $7 billion of net tariff revenue.
Right.
But we've lost $20 billion in agricultural alone.
Right.
So it's not a zero-sum game.
Inefficiency. Economic inefficiency, yes.
So the West Coast, and I expanded here into the rest of the country, the regional breakout here. West Coast volumes fell off a cliff. You see that's driven a lot of Southern California regional activity, but there was a lot of Northern California that fell off in that as well that I didn't show. Some of the Northwest volumes are starting to contract, coming off those potatoes and apples that we saw in Washington. So what is some positive news, because I feel like we've been a little bit negative.
I feel like you've been. Give me something.
I actually talked myself into a depression.
See?
Not that long ago.
Look at that.
And but some positive news is that the Midwest volumes are starting to pick up here in this last little bit.
Gotcha.
It is negative 1% year over year, but we are starting to see that regress closer to a positive number, and it's been 4 to 5% down for months. Weakness in Chicago, where we are positioned currently. Outbound volumes really down. Again, related to trade war activity.
Right.
It's not coming across the country yet. It's been going into the East Coast. So next up, what's it done to capacity? Spot rates year over year way down.
Right.
Not great, but let's not compare it to 2018.
Yeah.
Again, overheated year. What is somewhat, not great, is that we're seeing kind of this softer peak compared to June. We want to see a nice, robust November, December peak. Outbound tender rejection rates still pretty far down. Something to note, though, that I find interesting is that we are still outperforming the spring.
Okay.
April and May, not necessarily strong times of year, but we are outperforming those in terms of rejection rate and also spot rate activity, or spot rate.
So better
number.
than worst.
Yeah, it's better than the worst. So we're not totally off, but fall peak, according to our freight futures market, is projected to be about 5% under, June. And again, we're about 15% under last year's peak.
Yeah.
So, if you look at those numbers, that is a little bit concerning. I think it's no secret at this point, we are in a softer market than we were in 2018.
Definitely.
A lot of this is actually going to be a little bit of a hangover because we were so overheated in 2018.
Definitely.
Economically speaking, and that transitioned into the freight market. So I wanted to talk about intermodal. Now, this section of the freight market has been generally in line with trucking. So in terms of other surface freight, the rails and trucks, they compete somewhat, not on the carload side, but a lot on the intermodal side. So
Gotcha.
Rails traditionally will go for the longer haul freight
Right.
and go across the country, Los Angeles. So I was always interested to see, we saw those Los Angeles volumes really drop off. Well, if you remember, I said this was a lot of that regional movement that fell off, not that longer haul movement. And what we're seeing here is intermodal rates, spot rates on rails, have actually increased through a very soft period of time.
Really?
Now you're saying, oh, well, it's obviously because everybody's choosing to go rail. And I'm like, actually, that's incorrect. Looking at the total intermodal containers year over year, we're actually accelerating in our decline year over year. We're now at 5 to 6% down year over year.
For intermodal rail.
For intermodal rail.
Now, is this
volumes.
because when we're looking at the trucking side, rates are so much more lower potentially, or
it actually doesn't make sense traditionally.
Okay.
The spot rates for trucking and intermodal tend to follow each other.
Right.
The rail controls its capacity a little bit stronger. They can take cars on and off. They can take things, they don't have to haul their freight. Their costs are very low. Most of those containers are incremental,
Gotcha.
meaning they don't cost a lot to put an intermodal container on that rail. But intermodal volumes down year over year while rates increase year over year. So it's really, to me, this is a concerning signal for trucking. Especially going into the fourth quarter peak. It looks to me like we're in bid season right now. That's the time of year where all these shippers go through their process of evaluating their carriers and providers, and then they purchase, more transportation for the year. And seeing that it looks like the rails are honestly just taking the volumes away that pay lower amounts.
Okay.
So they're essentially firing customers and getting more money and better paying. Their revenue quality is increasing while their volumes are decreasing.
Gotcha.
So it's an impressive feat. The rails obviously
indeed.
are an oligopoly. They're not necessarily the, trucking is the exact opposite of an oligopoly.
Right.
So they do have a little bit more control in that. And I wanted to also note here that the air cargo, so air cargo tends to follow the transportation industry pretty well. It actually can lead it at times. We're seeing the same exact thing in air cargo
Okay.
that we've seen in trucking this year. And that's very soft numbers compared to 2018. We expect to see a peak. And what I look for every year is this peak coming from Hong Kong to North America. So what you're looking at behind me, Transportation Air Cargo Index, basically spot rates for air cargo coming from Hong Kong into North America.
Right.
And what we're seeing is kind of a muted peak.
Okay.
Hong Kong and also Shanghai into North America, muted peak. Not really ticking up like we'd expect it to, but it is going up. So they've already started to enter their peak, which is good news for the trucking and surface transportation side.
Right.
Some of those rates are going to, we would expect it to expand a little bit more, but we're already seeing some contraction on the Shanghai to North American side. So that's not great news.
Gotcha.
Especially as we get closer to Thanksgiving. So the oil markets. Now this one's a little bit interesting. We're going to move on to, before we close down and summarize here, oil markets pricing. We're seeing increasing retail prices.
Yeah.
Now back in September, we had the Saudi attacks, we elevated the retail price of diesel, and we've seen that stay flat for the last several months.
Interesting.
And we're heading into the next year, which is IMO 2020.
Right.
Which is expected to have a big impact into the overall freight, in terms of how people are going, their costs. They're going to have to pass along all these costs into the rest of the world. So we're seeing a big uptick in retail prices, which is somewhat contrary to the rack prices, which is the wholesale price. So we're going to see if this one sticks moving forward.
Gotcha.
So, yeah, I think we wrapped it up pretty well.
I think so. I think that really covers it,
yeah.
Especially when we look at the econ trends and translating it to freight. And Zach, even though we don't always agree, I enjoyed doing this with you on a regular basis. And I think we're going to get a little bit more of an opportunity to chat on a regular basis.
Why is that, Anthony?
We have a podcast coming out.
Oh, man. What's it called?
Freightonomics.
Feelings and facts?
Freightonomics. Where feeling and facts meet.
Right.
But we will be casting what is on Freightcast?
Freightcast, yeah.
Freightcast.
Be sure to subscribe to Freightcast.
That's right, because it's going to be available a lot sooner, immediately after we finish recording. And so Zach and I would love to have you there.
Yeah.
Looking forward to going over freight and economic trends on a weekly basis.
Yeah, really translating, the macroeconomic. I know when I was out in the world, I didn't really pay that much attention to what was going on outside me.
Right.
And it really made me blind to what was going on. So I think this is just going to be another added layer. Also, we're going to have some fun.
We're going to have a lot of fun. We're going to have a lot of fun. We're going to have a blast.
You're going to see me and Anthony wrestle. Well, you won't, because it's a podcast.
No. Well, maybe we'll have a camera one. I don't know. We'll see us.
All right, so coming up here in 1 minute, we've got John Kingston.
Not John Kingston.
He's John Kingston. You thought I knew?
I had no idea. John Kingston, hello. All right, well, we'll have John Kingston coming up next.
All right, guys. That'll do it.